What's up, everyone? Happy Finance Friday. You're here with Finance CJ. Hope you all had a good week, and I know it was a rough one coming off a holiday break. I know I had a rough time getting through the week, but today we're going to talk some personal finance, and we're going to get down to some investing. Now, remember, I am not a licensed professional, and this is not formal financial advice. This is just my recommendations on what I would do if I was just beginning. Most people know that starting in the stock market is the best way to make money. Other people like to go the real estate environment. Either is a good option. We'll talk about real estate later. Before we talk about investing in the stock market, we're going to talk about what the stock market actually is. Now, the stock market is easily imagined as an imaginary store where instead of buying a physical product, you're going to be buying portions of a company you own. Imagine some of your favorite companies like Apple, Starbucks, Amazon, and you want to be a part owner of each of those companies. You can do that in the stock market. To do that, we're going to talk about where you can begin to find options to start your portfolio. For the younger generations, we like to go to more techie options such as Robinhood, Webull, and SoFi. And the older generations tend to lean more towards Charles Schwab, TD Ameritrade, and even going through their local bank with a banker. If you didn't see my last video on Roth IRAs, it's another option to getting started in the stock market. It'll be in the link at the end of the video. To begin in the stock market, it used to mean you had to have a lot of capital to start, a lot of money on hand, used to take money to make a trade, and you could only buy whole shares of a company. Robinhood came in the game and changed it all back in 2015. Robinhood made it so you could invest with as little as $1. They made it so you can buy fractional shares, and they made zero commission trading, which was huge. Basically, that meant anyone with an internet connection and expendable cash was able to get started in the stock market, which was exclusively for the wealthy. Anyone from a teacher, garbage man, postal worker, security guard, audio technician could get invested in the stock market. Now, the first thing you need to do is find the brokerage that works for you. You need to do your research, figure out which brokerage you like, the user interface, the user rating, and make sure you know about its dependability. I know Robinhood in the past has had issues with their dependability. Being able to make trades during trading hours can be the difference between a options trader making thousands of dollars and losing thousands of dollars. For me, I use SoFi and I use Webull. Personally, I love the user interface of SoFi, and that is why I continue to use it. I started investing back in January. I have exclusively used SoFi up until I got the offer for a free stock through Webull. Check it out. You can always sign up with Webull for $100, and they will give you 2 free stocks. Be on the lookout for an affiliate link coming later. Let me know in the comments what kind of brokerage you use and if you will be starting a new one. Also, let me know if I should start a Robinhood investment portfolio down below. So what now? Once you made the selection of the brokerage, it's time to set your foundation for your investing career. The best place to start with is deciding whether you want to be a dividend investor, a growth investor, or a mixture of both. I like to find myself as a dividend investor. Again, I just want to remind everyone that this is not financial advice. This is just my own personal opinion. Do your own due diligence when investing. As a dividend investor, the most important thing for me is the passive income that I earn from the stocks that I have. I invest in stocks that pay me passively, meaning even while I'm sleeping, I am making money. These companies pay me just for owning pieces of the company. This will allow you to grow your account on a consistent basis and keep your money working for you. I invest weekly because I get paid weekly. For everyone, that's different, but the best thing you can do is set up automated deposits that work for you, whether that be weekly, monthly, quarterly, whatever works for you, in the sense that you are consistently adding money to your account and you are letting your money work for you. Investing on a consistent basis allows you to let your money compound for you. This also is known as dollar cost averaging, meaning you are going to invest in the market no matter what, whether it is up or down, and it is going to get you a true dollar cost average for the stock you are buying. Lastly, I would recommend diversifying your portfolio. You don't want to be too heavily invested into one sector because one bad news in that one sector can send your whole portfolio down 5, 10, 15%. You instead want to invest in several sectors, protect yourself from those types of crashes. For example, one reason I invest in financials is they're very steady. When the retail industry crashed, the financial industry was strong. This will allow you to save most of your money when you are investing. As new investors, we're all going to make mistakes. We all hear the common phrase of buy low and sell high. It's much easier to say that than it is to do that, because what that doesn't take into account is everyone's own emotions. So what we're going to talk about are some common mistakes that I have made and that I've heard people make in the stock market. When the stock market's good, everyone's happy, the money keeps flowing, stock prices are going up. But what happens when your portfolio takes that hit? When you lose 5% on your portfolio, when you lose 10% on your portfolio, when you lose 20% on your portfolio. COVID hit back in March and the stock market went down 40 to 60% in a matter of a couple weeks. What are you going to do? The worst thing you can do is sell your companies at those lows, because you are then flipping that narrative. You are buying high and you are selling low. This will cost you the most money in the long run. Another common mistake I see, especially within Robinhood investors, because of the top movers category within the Robinhood app, is people like to jump on a hype train. Jumping on these hype trains will cause you to lose your money because you're buying it on an upswing when people are going to be pulling out their money and taking their profit. Again, this will cause you to lose money. We don't want to lose any money in the stock market. We want to build a safe and secure portfolio, or as close to one as we can get. A few other smaller common mistakes are just looking exclusively at the share price, meaning you're just looking at what the stock is currently trading for rather than its price to earnings or its market cap. You're not doing your research. A stock that is trading cheaply to its earnings but appears expensive to you because it is over $200 a share is a common mistake. Another thing that people do as dividend investors is they look exclusively at the yield. And the problem with this is when the yield keeps growing on a company, people get excited, but in reality, that can mean that the company is failing. With the yield going up, that means the share price is going down. This means the company is losing money or there's something wrong with the fundamentals of the business. We need to address why the stock is going down, why the yield is going up, and how we feel about this as an investor. The best thing to do is to make sure that you feel confident and secure in the business as a whole so that you know your money is going to keep making you money and not lose. Finally, do not try to time the market. Timing the market can be the worst thing for an investor to do just because it is nearly impossible to tell when a stock has reached its peak or its low. We'll see in a little bit why it's better to dollar cost average and keep your time in the market versus timing the market. I'm going to tell you a story about Jeremy Schnider, who runs Personal Finance Club. He did a study based on if you were to time the market perfectly, time the market incredibly terribly, and if you just consistently invested over the past 41 years. So we're going to go through the study, and I'll link the study down below and link his Instagram page as well. If you're looking for a fun take on investing advice and personal finance, it's a good follow. Back to the study though. Person A, Person B, and Person C all have $99,000 to invest. Person A invests at the worst time throughout the past 41 years in the market. They invest at the all-time highs right before every crash over the past 41 years. Person B does the exact opposite. They invest at the best times of all the lows of all the crashes in the past 41 years. Person C invests consistently every month over that same time frame. Who is going to have the most money in the end? The answer may surprise you. It's Person C. They end up with 1.7 million. Person B ends up with 1.1 million. And Person A ends up with 775,000. All respectable retirement numbers because you can actually live off all that money for your retirement if you invest it right in a 4% yield dividend account. The moral of the story here is that investing consistently allows you to hit all the run-ups, even though you're hitting all the lows as well, you're not missing a big day in the stock market. You're allowing your money to stay in the market and compound faster for you. With this money in the market, you are building your wealth at an incredibly fast rate, and you are not stressed out from trying to time when the low is going to be, when the high is going to be, selling at the high and buying at the low. You're not going to strain yourself trying to predict when the market will crash or when the market's going to hit its all-time high. If person C sounds like you, I would recommend an index fund, especially if you can just put your money in it and not even worry about it and don't even look at it. If index funds sound fun to you, I definitely recommend checking out the Roth IRA video because I talked about some of my favorite index funds and some of the best potential index funds in my last video. I will end with a question that Warren Buffett commonly asks when investing. If you selected a company, you would need to feel comfortable enough with it that you would not look at the share price for the next 5 years and still feel comfortable investing in it. Now think about that every time you pick a company. I like to think of Apple as this experiment. I would feel comfortable investing $1,000 in Apple, putting it there and leaving it there, and checking back in 5 years and knowing that my money will still be there and then some. For those of you who are still with me, thanks for sticking around. Hope you enjoyed the video, and don't forget to hit the like button, subscribe, comment, and hit the notification bell, just so you know when my video is posted. Remember to follow me on Twitter @FinanceCJ, and a special thanks to the man behind the screen, Mr. TJ DeRosa himself, for all the audio and visual work. I hope to see you guys back here next week for Finance Friday. I post every Friday at 5 p.m. Have a good night.